Welcome back, real estate enthusiasts! Today, we're diving into a debate as old as investing itself. Real estate versus stocks. Yes, the age-old question that has puzzled investors for generations. You see, both real estate and stocks have their unique strengths, and both can be powerful tools in the hands of a savvy investor. But which one offers the best return on investment? Which one is a better fit for your financial goals and risk tolerance? Well, that's exactly what we're here to find out. We'll be taking a deep dive into the world of real estate and stocks, comparing their pros and cons and weighing the risks and rewards. Whether you're a seasoned investor or a beginner just starting your financial journey, this is a discussion you won't want to miss. So buckle up and join me as we explore the ins and outs of each, helping you determine which is right for you. Let's start with real estate. The tangible allure of property ownership. There's a certain charm in holding the keys to your own property, isn't there? What makes real estate such an appealing investment, you might wonder? Well, it's a multifaceted answer, yet it's simple in its essence. Firstly, real estate can provide a steady stream of income, especially if you're renting the property out. This rental income can be a significant addition to your regular income, potentially even replacing it in the long run. Imagine a life where you're financially secure, thanks to your smart real estate investments. Quite the dream, right? But the benefits of real estate don't end there. Over time, properties have a tendency to appreciate in value, often significantly. This long-term appreciation can be a powerful wealth-building tool. You are essentially buying an asset that, in all likelihood, will be worth more in the future than it is today. That's the beauty of real estate. Now, let's not forget about the satisfaction of owning a physical asset. There's an undeniable sense of achievement and security that comes with owning property. You can see it, touch it, live in it, or rent it out. It's a tangible asset that you can use and enjoy while it potentially grows in value. However, it's important to remember that real estate investments do require a greater initial investment compared to stocks. Yet this can be mitigated by leveraging mortgages and loans to finance the purchase. This way, you're not just relying on your own capital, but also using borrowed money to grow your wealth. In a nutshell, real estate offers a unique combination of benefits that make it an enticing investment option. With real estate, you have the potential for steady rental income, long-term appreciation, and the satisfaction of owning a physical asset. It can be a powerful tool in your financial arsenal, providing you with financial stability and growth. But like all investments, it's essential to do your homework and make informed decisions. But wait, don't dismiss stocks just yet. Let's dive into the dynamic world of stock investing. What makes it so appealing? Well, 3 words: liquidity, diversification, and potential growth. First, let's talk about liquidity. Unlike real estate, which can take months to sell, stocks can be bought or sold virtually instantaneously. This liquidity means you can access your investment at any time. So if you need to cash out quickly, stocks provide that flexibility. Now, on to diversification. With stocks, you aren't just investing in one company or one sector. You can spread your investment across different industries, different countries, even different kinds of stocks, from blue-chip companies to promising startups. This diversification not only spreads out your risk, but also opens up opportunities for greater returns. Speaking of returns, let's not forget the potential for rapid growth. While real estate may provide steady long-term returns, stocks have the potential to skyrocket in a relatively short time. Remember the tech boom or the rise of e-commerce giants? Strategic stock investments have turned modest sums into significant wealth. But, and there's always a but, this potential for high returns comes with increased volatility. Stocks can climb mountains, but they can also plummet into valleys. That's why it's crucial to have a balanced portfolio and a well-thought-out investment strategy. So there you have it. The stock market, with its liquidity, diversification, and growth potential, offers an attractive investment avenue. But like all investments, it also carries risks. The key is to understand these risks and manage them strategically. To sum it up, the stock market offers unparalleled liquidity, diversification options, and the potential for rapid growth through strategic investments. So if you're looking for an investment with flexibility, variety, and high growth potential, don't dismiss stocks just yet. After all, finding your financial fit is all about balancing your portfolio with the right mix of investments. Now, let's compare the risks. Real estate investments can be more stable and less volatile, but they require significant upfront capital, maintenance costs, and market fluctuations can impact property values. Delving into the world of real estate investment, it's important to understand that this path is not without its challenges. To begin with, there's the issue of the substantial initial investment. Buying property isn't cheap, and it often requires a hefty down payment. This can be a significant barrier to entry for many potential investors, as it ties up a considerable amount of capital that could be used elsewhere. Then, there's the ongoing cost of maintenance. Unlike a stock portfolio that you can manage from your computer, real estate is a tangible asset that needs constant attention. This could mean anything from a leaking roof to a broken heating system. These unexpected expenses can quickly eat into your profits and require a level of hands-on management that some investors may not be prepared for. Another risk factor to consider is the volatility of the housing market. While real estate is often considered a safer bet than stocks due to its perceived stability, it is not immune to fluctuations. The value of your property can go up and down based on a variety of factors, including economic conditions, interest rates, and even neighborhood trends. This means that your investment is always at the mercy of the market, and there's no guarantee of a return. To top it all off, real estate is not a liquid asset. Unlike stocks, which can be sold at a moment's notice, selling a property can take months, even years. This lack of liquidity can be a significant drawback, especially in times of financial hardship when you may need to access your investment quickly. Real estate investments can be more stable and less volatile, but they require significant upfront capital, maintenance costs, and market fluctuations can impact property values. So while real estate can certainly provide a solid return on investment, it's crucial to weigh these risks and consider whether you're ready to take them on. On the other hand, stocks can be more accessible with lower entry barriers, but they're subject to market volatility, economic downturns, and company-specific risks. Now, let's delve into this a bit deeper. When we say stocks are subject to market volatility, we're referring to the fact that stock prices can fluctuate wildly in a short amount of time. This is both a risk and an opportunity. On one hand, you could make a significant profit if the prices go up. On the other hand, you could lose a substantial portion of your investment if the prices go down. Economic downturns also pose a risk to your stock investments. In times of economic uncertainty, such as during a recession, companies may struggle to maintain their profitability, which can lead to a drop in their stock prices. This is why it's important to diversify your investment portfolio and not put all your eggs in one basket. Then, there are company-specific risks. These are risks associated with the specific company you're investing in. For instance, if the company's management makes poor decisions, or if there are significant changes in the industry that negatively affect the company, the value of your stock could decrease. However, it's crucial to remember that while these risks are real, they don't necessarily make stock investing a bad choice. In fact, the potential for higher returns is one of the reasons why many people choose to invest in stocks. But it's not for everyone. It requires a solid understanding of the stock market and a willingness to stay informed about economic trends and industry developments. In the end, it's all about your personal financial goals, your risk tolerance, and your investment timeline. Stocks can offer higher potential returns, but they also come with a higher level of risk. So, if you're someone who is comfortable with taking on a bit more risk in exchange for the possibility of higher returns, investing in stocks may be a good fit for you. Stocks can be more accessible with lower entry barriers, but they're subject to market volatility, economic downturns, and company-specific risks. So, which is right for you? Well, it depends on your financial goals, risk tolerance, and investment timeline. We've journeyed through the world of real estate and stocks, and it's clear that both have their unique allure and potential pitfalls. Let's recap. Real estate offers the tangible satisfaction of owning a physical asset. It has the potential for steady rental income and long-term appreciation. It's a more stable and less volatile investment, but it requires significant upfront capital, maintenance costs, and fluctuations in the market can impact property values. On the flip side, stocks offer unparalleled liquidity and diversification options. They give the potential for rapid growth through strategic investments. Stocks are more accessible with lower entry barriers, but they are subject to market volatility, economic downturns, and company-specific risks. So, how do you choose between the two? It boils down to your personal financial goals, your tolerance for risk, and your investment timeline. If you're looking for a passive income stream and long-term wealth accumulation, real estate might be the more suitable option. It's a slower, steadier path to wealth accumulation, and it allows you to build equity over time. However, if you're after higher returns and greater flexibility, stocks could be the way to go. They offer the potential for rapid growth and the ability to diversify your portfolio across different sectors and companies. Plus, you can start investing in stocks with a much smaller capital compared to real estate. It's crucial to remember that both real estate and stocks come with their own set of risks. Be it market volatility, economic downturns, or property maintenance costs, it's important to thoroughly understand these risks before making your investment decision. Perhaps the most important takeaway is that you don't necessarily have to choose between one or the other. Diversification is a key principle in investing. By spreading your investments across different asset classes, you can potentially reduce risk and maximize returns. And let's not forget, your personal circumstances and preferences play a significant role too. Some people find the process of buying and managing properties exciting, while others prefer the thrill of trading stocks. It's all about what suits you best. Well, folks, that wraps up our exploration of real estate versus stocks. Remember, there's no one-size-fits-all answer. It's all about finding the right balance for your financial portfolio. Whether you lean towards real estate, stocks, or a mix of both, the most important thing is to make informed decisions that align with your financial goals and risk tolerance.